Hey, good afternoon, and welcome back, everyone, to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we are going to be embarking on understanding debit versus credit spreads. These are kind of your first, or rather your second level up with regards to trading options once you learn the basics of trading single leg options. Once you learn buying a call, buying a put, looking at potentially selling a call or selling a put, you recognize that single leg strategies have some limitations for each of those strategies. Predominantly, either it requires the stock to make a very large move before the strategy is profitable in the case of long calls and long puts, or you have unlimited risk or it requires a huge amount of margin in order to short a call or a put. So debit and credit spreads are really an improvement, if you will, of some of these single leg strategies that give you many of the benefits of the single leg strategy, but reduces some of the limitations or drawbacks of those strategies. So today we'll take a deep dive of both strategies and give you an understanding of how to utilize them in your own trading. Before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are using as example purposes during today's session. So we'll start off with a quick introduction to vertical spreads, make sure you understand what they are, and then we'll dive into debit vertical spreads first, and then cover credit vertical spreads before we look at some examples and outcomes. The best way to learn is to go through some examples, see how each one of these strategies perform in different conditions so that you can truly understand the difference between debit versus credit spreads. I usually get a lot of questions from customers asking, which one should I choose? Should I trade debit versus credit? And from my perspective, they are used in different conditions and different scenarios. So it's not about choosing which one's better. It's about applying the right one for the right outlook that you have. So we'll discuss kind of what the outlooks are and making sure that you are applying it correctly. And then I have a cheat sheet at the very end to help you remember some of the things that we learned here during today's session, and then we'll open this up for Q&A at the very end. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can you minimize risks while maximizing profits by leveraging multi-leg option strategies such as debit versus credit spreads. So let's first start off by just briefly introducing what a vertical spread is. It's a strategy, it's a multi-leg strategy, specifically a two-leg strategy where you're buying and selling a call or a put on the same expiration date for a specific underlying strategy. An underlying symbol. And it's a strategy that has limited risk to take a directional view on the market. So basically, it's a strategy for when you believe that you think a stock or an ETF is going to either head higher or head lower. That's when you might want to use a vertical spread, and it has limited risk. It's suitable for both, either mild or directional bullish and bearish outlooks. What do I mean by that? Is that, in some cases you have a stock and you believe that stock is going to make a very big move in a short amount of time. And then there are other times where you say, this is generally trending higher. I think it's going to slowly kind of grind its way higher. I don't think it's necessarily going to make any big moves, but I'm pretty confident that I think it's going to continue to drift higher. In either one of those two scenarios, you can use a vertical spread. But the third thing that I think a lot of traders may not quite realize is that in today's world of, where nearly 95% of options trading is done 100% electronically against a computer, meaning there's no one on the other side of the trade anymore. Because vertical spreads have limited risk to you as a trader, it also means that the trader on the other side or the market maker on the other side also has limited risk. And generally speaking, market makers prefer trading strategies that have limited risk because it's easier for them to define, their risk tolerances on the other end of the trade. So you generally will actually see better liquidity on these limited risk strategies as well. So those are some of the things to consider when you're thinking about these types of strategies. But the most important part is the fact that these strategies have limited risk. It's easy for beginners to kind of get started with some of these strategies. So let's start by talking a little bit about debit spreads first. Um, Debit spreads, give you an ability to leverage your capital on a stock or ETF that you believe that you have a strong directional view on. So let's say you believe that the stock is, I'm just taking Marriott for an example here. Let's say the stock has been in a long bullish trend, and you believe that that bullish trend is about to end, and you're concerned that this thing is about to drop. And maybe you believe that once it breaks that support, it's going to quickly tumble back down to maybe $170 or $180. And you believe that it's going to make a big move in a short amount of time. This could be because earnings are coming up, maybe because, the economy is not doing well, and you think that this is the type of client that's going to, or this is the type of stock that's going to underperform in that type of environment. Whatever your reasons are, debit spreads are for when you believe that the stock is going to make a fairly significant move in a short amount of time. And what the debit spread strategy allows you to do is leverage your capital and provide you with a very strong risk reward, but it requires you to pay time decay, meaning the value of the option will decay each day you hold on to it. That's going to work against you. So you must believe that the stock is going to make a quick and fast move in order to justify paying that time decay on a debit spread. And this is a strategy that has limited risk and limited reward. So you know exactly how much money you can potentially make or lose on this particular trade before you get into the trade. And what that means is that you have absolutely no excuse when you're trading these types of strategies to say at the end of a trade, oh, I lost too much money on that trade. Because if you ever find yourself in a position trading any of these types of strategies saying, hey, I lost too much money on that trade, it's not the trade that was bad. It's the number of contracts that you traded was too large for your portfolio because you knew exactly how much money you could potentially lose on that trade before you get into the trade. So you really have zero excuse, or rather, I think the better way to frame it is that you need to rethink how many contracts you trade when you trade these types of strategies. If you ever find yourself in a position where you feel I've lost more money than I originally anticipated losing, or I've lost more money than I feel comfortable losing when I traded one of these strategies. And I'm only mentioning this because I've been a market strategist for 18 years, and I have seen this type of behavior day in and day out, where customers will come to me after a bad trade and say, hey, I lost way too much money on that trade. And, they'll say, my strategy was wrong, or I had bad advice, or I had bad, someone told me about this stock and I thought it was a great idea and I lost so much money on it. And I always tell that customer, it's not the idea that was bad. Ideas are a dime a dozen. What was bad was the number of contracts that you traded on that idea. You have full control over how many contracts you trade, and that is the only way to ever prevent yourself from, quote unquote, losing too much money on one trade. And this is really why I think this is one of the strategies that every beginner needs to master, because you truly have control over how much you can potentially make or lose, which means that you will always be in control of your portfolio and making sure that you don't blow too large of a hole in your portfolio when you're trading these types of strategies. Okay. So let's look at an example here. I'm going to use this Marriott example. Let's say the stock has been rallying for quite some time and has started to stall. It's kind of trading sideways now, and you're concerned that this stock is now going to break below this $200 support level, and you think perhaps it's going to tumble quickly into the 180s, potentially even into the 170s. So what do? Let's say we go out to the May 17th expiration and we look at buying a $200 put option. Now, this is what you would do if you were trading a single leg option, meaning if you were just trading, if you're just learning how to trade options and you're just trading single leg, you'd be inclined to just buy a put option when you have a bearish view on the stock. But as we previously learned, when you buy a put option, what you pay for that put option, that's how much the stock needs to move in order for you to overcome the time decay. So you have $7.75 that you're paying for this $200 call option, $200 put option. So your break-even price is below 193 just for you to break even. So meaning even if the stock drops to 193, you're not going to make money at expiration. You've only broken even. You have to believe that the stock will be materially below 193 in order to justify buying that put option. And you just simply may not find yourself in that position every single day. And it just requires the stock to move, in this particular case, at least 3% lower before you even make any money on this trade. So the reason we trade a debit spread is that when we buy a put option, um, we're basically paying for unlimited downside protection all the way down to zero, right? We're basically saying for that $7.75, the stock could potentially reach zero. But in reality, between now and May 17th, which is maybe roughly, a month and a half away, there's a limit as to how far I think that stock can go. So why should you pay for all that downside if you don't actually believe the stock is going to be materially below 180? So what you can do with as an option trader is you can sell a 180 put and collect some premium. And what that's going to do is going to reduce the amount of cost that it takes to get into the trade. So instead of paying $7.75 and risking $775 per contract by selling the 280 puts, I'm sorry, the 180 puts and collecting $2.38, you've reduced your total outlay down to just $537. So you've reduced your overall risk in this particular case by nearly a third. You're reducing your overall risk by roughly 30%. You're reducing the amount of capital outlay it requires to get into the trade in exchange for limiting your downside below 180. So if the stock were to drop below 180, you're not going to be able to participate on further downside below 180. In exchange for reducing your overall risk and overall capital outlay by roughly 30%. And this is really where you have to be smart in terms of picking which strike price you want to sell. That could be based on your target price. That could be based on probability. We'll talk a little bit about how to select that appropriate strike price, but generally speaking, going out about one standard deviation is a good starting point as to choosing that strike price. And you'll typically reduce your overall risk versus buying that put option by nearly 25 to 33%, generally speaking. So by reducing your risk, you're basically giving away a little bit of profit potential, but you're reducing your risk fairly substantially by trading a vertical spread rather than just buying that put option. So let's say you were to go ahead and deploy this 200 by 180 put vertical spread. Let's take a look at how the strategy will actually perform in the different scenarios. So let's take the first scenario. Let's say the stock were to drop below 180, right? So by the expiration date, the stock drops below the $180 mark. Well, at that point, what you're going to do is you're going to realize the full $1,463 profit. How do we arrive at 1463? It's the difference between the 200 and 180 strike price that we purchased. That's $20 difference between 200 and 180 minus the $5 and what did we say? $5.37 that we paid for it. So $20 minus $5.37 that we paid for it is $14.63. And because each contract represents 100 shares, $14.63 times 100 is $1,463. So if the stock were to drop below $180, you would realize the full maximum profit potential of the strategy of 1463 per contract that you traded. And what that means is that if the stock were to drop to, let's say, 160 or 150 or 140 or 130, the most you will still only make $1,463. You will not make any more money even if the stock drops any further below $180. That is the opportunity costs that you're giving up by reducing your overall risk by that 33% roughly on this particular trade. So it's important to understand what you're giving up. And that's why choosing the right strike price makes sense, right? And if you look at your chart here, you see that 180 was kind of the level that it was bumping up against before it broke out. That's a reasonable target to the downside. And that's part of why selecting a strike price at 180 probably makes some sense, because even if the stock were to drop, it probably will stall a little bit near that 180 area. It could drop further, but it likely will find a little bit of support, excuse me, around that 180 area. And this is why we've chosen the 180 strike. But this is really how you want to think about this particular strategy. Now, this is best case scenario. The trade works out exactly the way you expected to. You're going to make a $1,463 profit. But what if the stock were to drop? But it doesn't drop very far. Let's say it ends up somewhere between $180 and $194.63. $194.63 represents the break-even price. That's $200 minus $5.37, what we paid for that strategy. So if, let's say the stock ends up somewhere between 180 and your break-even price of 194.63, you're going to profit, but you're not going to profit as much. You're going to profit somewhere between 0 and 1463, meaning if the stock drops to exactly 194.63, you're going to make $0 profit. If the stock drops somewhere in between, it's a linear scale. You basically are anywhere from between 0 and 1463. The closer you are to 180, the closer you'll be to 1463. The closer you're to 194.63, the closer you are to 0 with regards to your profits. So it really just depends on where the stock lands on expiration. That's going to determine how much profit that you have if it lands somewhere between those two numbers. Now, let's say in the third scenario, the stock drops, but it stays above your break-even price at 194.63. So it's somewhere between 200 and 194.63. Let's say the stock's currently trading at 200 and the stock lands at 198. Well, in that particular example, you got the directional view correct because the stock moved lower, but it moved lower by only $2, so not very much. In this particular example, this is the downside of being long options, right? So when you're buying a put option, when you're buying a debit spread, the stock has to move before you're profitable. So even if it moves a little, you can potentially get the directional view correct and still lose money on that trade. In this particular example, you're just going to lose less money than if you were to just buy that put option. Because if you just bought that put option, you have $775 worth of risk. Here, you only have $537 worth of risk. So you reduce your risk by over $230 or so. So in this particular case, you could still have some losses, not a lot, but you will have some losses in this particular example. And in the last example, if let's say the stock just fully stays above 200, the stock never drops below your support level, well, that's really when you lose your full $537. So what you're doing is you're risking $537 to potentially make $1,463. And that strong risk to reward ratio is what attracts traders to this specific strategy when they believe the stock can make a big move in a short amount of time, right? So if you're confident that you feel that this stock, is going to break that support level, and if it breaks, it's going to move quickly. This is a type of strategy that allows you to capture that move by risking a small amount of capital to potentially make, in this particular case, nearly triple that amount in profits if the outlook you expect actually materializes. So when you expect the stock is going to make a fairly sizable move in a short amount of time, debit spreads give you the leverage that you want while risking a small amount of capital to potentially make 2 or 3 times that back if you get the directional view correct. I hope that makes sense, everyone. And that's why and once we look at credit spreads and you kind of see the difference between the two strategies, you'll see it, you almost never will be in a position where you have to choose between a debit or a credit spread. You will very easily tell based on your outlook which one of the two strategies makes sense for you. And hopefully this illustrates for you when you might want to use a debit spread. Okay. So lastly, let's cover kind of once you're in a debit spread, how do you typically think about managing it, right? Because getting into the trade is the easy part. What you do as you hold on to that position and you see the P&L tick higher and lower, and sometimes you go into a loss, sometimes you go into a profit, and you're constantly trying to figure out when do I close out this trade. This is really where we've done a lot of research on this, and we want you to kind of have some rules around when do you take profits and when do you cut losses. And with debit spreads, the rules are fairly straightforward. There's a pretty clear threshold as to when you should cut your losses and pretty clear threshold as to when you should start taking profits on your trade. And those thresholds are if you lose 50% of the premium that you pay, you should consider getting out of a loss. And if you have made 75 to 100% gains on your trade, those are criteria to consider starting to take profits on that trade. Now, that is for those of you that want to actively manage these trades. You don't have to do that because these are fully limited risk, limited profit potential strategies. You absolutely can hold these to expiration. There's nothing wrong with holding them to expiration as long as you calculate the correct number of contracts that suits your risk tolerance. Using these types of strategies are going to be very helpful in making sure that you stay in your lane with regards to managing your risk. But for those of you that want to stay more active and stay on top of your positions, this is one way that you can do that. So for example, in the example where we paid $5.37 for your strategy, the rule of thumb here is to look at closing out, is to look at closing out your trade at about $10.75, which is a 100% gain on what you've paid. That's a good time. So if the value of your debit spread, if you entered it at $5.37, once it increases in values to about $10.75, that's the equivalent of about a 100% gain. That's time to start taking profits and potentially getting out of the trade. And then for when the trade goes in the opposite direction that you expect it to, that's when if the debit spread that you paid initially for $5.37 is now trading at $2.69, that's roughly half of the value of what you paid for. That's an opportunity to cut your losses and move on from that trade. And this is something that will help you better understand once you're in a trade, how do you go about managing that trade? So hopefully this gives you a clear illustration of the strategy, when you might want to consider deploying this particular strategy for your portfolio. It's really for when you expect the stock is going to make a fairly sizable and quick move in one direction or another. So what I can do quickly is just show you on the First Trade platform. I want to show you kind of how you can find these types of strategies and deploy them for your portfolio. Give me 1 second to just pull that up. So for those of you that are using your First Trade account, within your First Trade account, you have access to Options Play. And Options Play is built to help you structure these types of trades instantly using our options wizard. Just give me 1 second to get this loaded up. I seem to always have some issues with Safari. Here we go. All right, so I'm going to use Apple, for example, here. I'm going to use Apple because it recently formed a bit of a double bottom here, and perhaps you think that now is a good time for Apple to bounce higher here. So maybe let's take a look at, trading some bullish strategies here for Apple. And what the options play platform does is it automatically constructs a debit spread for you. You just have to select the stock, whether you're bullish or bearish on the stock. And let's just say for now, I'm bullish on the stock. I think maybe Apple is due for a bounce, maybe into that 180 or slightly above that. It will automatically structure the debit spread structure for you. So the May 17th, 170, 185 call vertical trading at $5.14. Compare that to just buying the 170 call of $655 down to 514. You're reducing your risk here by about $130 on this particular trade. And one of the things, as you can see, is that if the stock, let's say, were to increase in value to, let's say, $180 by expiration, what you can see here is that if you just bought the call option, you're looking at a 52% return versus if you bought the debit spread, because you've reduced that risk by that $130. Doesn't sound like a whole lot, but you're increasing your potential returns from 52% to 94%. That $130 increases your leverage fairly substantially, to the point where if you were just to buy a call option, you're looking at a 52% return versus the vertical spread, you're looking at a 94% return. And that's really kind of why the debit spread is something worth learning if you started out buying calls and you're thinking about buying call options on a stock that you think is going to make a big move. Using that vertical spread, a debit spread sometimes can give you some pretty nice juicy returns if you do get that trading, if you do get the structure correct. And options play automatically creates that structure for you so that you can quickly find those types of strategies in your account. Okay, so let's now dive into a credit spread example. Now, just to be clear, credit spreads are more so for when you just generally have an overall trend in mind, right? So a stock is trending higher or trending lower. You don't particularly think the stock is going to make a big move one way or another, but you just see a clear trend and you think that that trend's going to continue. If you find yourself in that position, a credit spread is a strategy that you might want to consider. So here's Starbucks. It's trading currently around 96.93. Let's say you were to sell a call option in this particular case, right? Let's say you were to sell just the $97 call option. You'll collect $2.77. This is actually a strategy that by itself we generally don't recommend, because even though the trade structure may be very attractive, it's a strategy that we generally don't recommend because just selling a naked call has unlimited risk. So you want the risk profile of a short, but you don't want the unlimited risk nature of a short call. And that's when you turn to a vertical credit spread, where you sell the $97 call, collect $2.77, and then you buy a 102 call for 77 cents. So this has like the opposite effect of a debit spread. In a debit spread, um, you're selling a put option because you're trying to collect some premium, and you're basically saying, I don't think the stock is going to move materially below that specific strike price, like we did with that Marriott example. But here, what we're saying is that by selling a naked call, you have unlimited risk. So what we're going to do is we're going to go a little bit further out in terms of price, and we're going to buy some calls just in case the stock makes a really big move in the opposite direction that we expected to. We want to make sure we protect ourselves so that, in the unlikely event that instead of the stock moving lower, let's say some really good news out of Starbucks comes out and the stock pops up to 115. We want to make sure we protect ourselves in that particular example, because if we didn't buy that 102 call, the further the stock moves higher, the more money we lose on that strategy. We want to make sure we protect ourselves. So what we do is we basically buy a 102 put. We pay only 77 cents for it, which means that instead of collecting $2.77, we now only collect $2. So I'm reducing my overall income by a little bit on this particular trade, but if I were to sell that $97 call option, I would probably have to post about $2,000 to $2,500 in margin just to get into that trade. But by trading a vertical spread, I only have to post $300 worth of margin. So I'm reducing my capital requirements to get into the trade by probably close to 90% in reduction in exchange for giving up about $77 worth of income. So from my perspective, that's a trade-off that I'm more than willing to make when I'm looking at this, because now what I've done is I've changed my max risk, max reward to something that's far more suitable for me. Instead of making $277 in potential income, but risking unlimited amounts of capital, I'm basically saying I'll take $200 worth of potential reward, and then I'll cap my max risk at just $300. And what we'll do is we'll look at that example here again, just like we did before. Because if, let's say, Starbucks in this particular case continues this overall downtrend, as long as the stock stays below 97, which is the strike that I've sold, I'm going to keep my full $200 profit. And what's very interesting about this particular strategy is that if I get the directional view correct and the stock drops to $90, I make $200. But even the stock doesn't move. Let's say the stock stays exactly at $96.93. So I kind of get the direction wrong, right? Because it hasn't moved any lower. But in this particular example, I still make the full $200, even if the stock doesn't move. And that's really what's interesting about selling options, is that when you get the directional view correct, you make your full profits. But even if the stock doesn't move, you still make your full profits. And it's very attractive for a lot of traders from that perspective, because you don't have to get the directional view correct and still make the full profit potential on a specific trade. There are some trade-offs with it, but that is one of the main um, features that I think a lot of traders are attracted to with regards to selling options. And that's what a credit spread allows us to do. Okay. Now let's take a look at the second example. Let's say the stock doesn't move lower and actually starts drifting a little bit higher. And it stays somewhere between 97, which is a strike that we sold, and 99, which is our break-even price. Our break-even price is calculated based on the $97 strike that we've sold, plus the $2 of credits that we've received. That acts as a buffer. So before, when we're buying an option, what we pay is what we have to overcome before we make money. But as an option seller, what we collect acts as a buffer against, if the stock were to move against us, we can actually still be profitable. So, and this is something that for a lot of traders, that are used to buying options or buying stocks, is very counterintuitive, because when you buy a stock or buy an option, you need the stock to move in the direction you expect it to in order to make money. If the stock moves in the opposite direction, you will lose money. But when you're selling options, even sometimes when the stock moves against you, you can still be profitable. It's a very forgiving strategy. And that's why a lot of people like this type of strategy, is because of how forgiving it is. You can actually get the directional view wrong by a small amount, but still be profitable. So if it ends up somewhere between 97 and 99, you'll make anywhere between $0 to $200 in terms of profits, depending on how close you are to 97 or how close you are to 99. At 99, you make 0, and 97, you make 200, and it's a linear scale between those two numbers. So if you end up at 98, you'll still make a $100 profit on this particular trade. And if, let's say, you end up somewhere between the break-even price and the upper strike of the call option that you've purchased, that's when you start to lose money on this trade, anywhere between $0 to $300. And then only if the stock rises above your upper strike price of 102, that's when you will lose your full $300. But it doesn't matter how far the stock goes. If the stock goes to 102, you lose $300. If the stock goes to $150, you still only lose $300. If the stock goes to 1,000, you still only lose $300. So you cap your loss potential by buying that 102 call. And that's really kind of why we trade these vertical spreads. An extra $77 worth of income may not be worth it to take on unlimited risk in the event that the stock, for whatever reason, takes off between now and expiration. What you're basically saying is, I'll give up $77 worth of income in exchange. I'll make sure that no matter what happens, I'm only risking $300 on this trade. So, like I said, this strategy is very popular and attractive because of how forgiving it is, right? You get the directional view right, you make money. You get the directional view wrong by a little bit, you can still make money. And if if the trade really goes south, you control and limit the amount of capital that you risk. But the forgiving nature of this strategy, the trade-off of that is that you will always risk more than you can potentially make. So with any option selling strategy, you will typically always find yourself in a position where the most amount of money you can potentially make will typically be less than what you can potentially lose on the trade. But you have a much higher probability of success with these types of strategies, meaning you have a much higher chance that you'll make $200, and a relatively lower chance that you're going to lose the $300. So, everything with options is a trade-off, and there's no one strategy that's better than the other. So it's just a matter of understanding different trade-offs and different trade-offs before you decide when you want to deploy which one of these two strategies. Um, and from my perspective, I think a lot of traders will look at these types of strategies, and many times they'll look at them and not know exactly which strategy to trade. And I always refer back to the cheat sheet, which I'll show you here in 1 minute. That'll help you better understand and remember which one you want to trade. But before we do that, let's talk a little bit about managing credit spreads. So once you've sold the credit spread, when do you take profits? When do you cut losses? And there's an additional component of selling credit spreads that we need to be aware of, which is assignment risk. Because you are short an option, you are not in the driver's seat. You are at the mercy of whoever purchased that call or put option. So there's one additional rule for managing credit spreads that help you reduce your exercise risk. So let's first talk about um, um, profit and loss, and then we'll talk about the time-based rule. Okay, so in this particular example, we sold the credit spread for $2. The rule of thumb for taking profits, or let's start with stop loss first, is that if you lose 100% of what you collected, it's time to get out of the trade. So if the credit spread that you sold originally for $2 is now trading at $4, that means you've lost 100% of what you originally collected or what you could potentially collect on that particular trade. It's time to cut your losses and get out of the trade. If, on the other hand, the trade does go in the favor that you expect, it does go in the direction you expect it to, which is, it's something you sold for $2 is approaching zero, you generally want to consider starting to take profits at 50% of the maximum gain. So if you can potentially make $2 on a trade, once you make $1 of it, half of what you can potentially make, it's time to consider taking profits on that particular trade. So those are the two general rules for managing a credit spread. But if, let's say, you were to sell a credit spread and you are approaching 21 days to expiration and the stock has not take profit or stop loss levels, you generally also want to consider exiting that credit spread and perhaps selling a new longer dated credit spread. And the reason for this is because as you get it closer and closer to expiration, you start to have assignment risk, meaning the buyer of the call or put option that you've sold can potentially exercise that call or put, which will drastically change the outcome of your trade. It's not going to change the risk of the trade because you're just swapping out a short call or put with long 100 shares or short 100 shares. But you're going to need to have the margin requirement to purchase 100 shares or short 100 shares, which you may not have. So to generally avoid that and not be in a scenario where you're forced to be liquidated from position, The general rule of thumb is to exit a credit spread at 21 days to expiration. So let's briefly bring back up the options play tool once again. I'm going to use the Apple example here. Let's say, for example, you believe that Apple has maybe hit a bit of a bottom here, but maybe you don't think it's going to bounce back up to 180 or 185 quickly. You think it's going to be a very slow grind here to the upside because outlook on the economy isn't particularly strong. China's not particularly strong. You have, the earthquake in Taiwan that may put a little bit of damper in terms of upside for some of these stocks that rely on chips out of Taiwan. For whatever reason, you think that it's going to recover, but not a very strong pace. So you decide that now is a good time to sell a credit spread. So this is really where you can set up a credit spread here as well in options play, see what the max risk, max reward is, and actually use the P&L simulator and see if the stock were to stay around 165 or rather 170 because that's the current price of the stock. As you can see, if you sold a credit spread, you would make 100% of the potential return on that particular trade. But if you bought the call option or bought the vertical spread, you would lose 100% of your investment. And that's really the forgiving nature of these types of strategies, is that if the stock doesn't move, you still make the full profit potential. The downside to these strategies is that if the stock does move, right, you will only make that $185 profit, versus here you can turn a much higher dollar profit for the same amount risked. So that's really kind of the opportunity cost with these types of strategies. And the downside, you will also potentially lose more than you can potentially make on this particular trade, which is why we have those stop loss rules to try to help prevent kind of some of the bigger losses of these types of strategies. But the options play tool with First Trade is designed so that you can click a trade button, preview order, and actually have it automatically pre-fill your order ticket for you so that you can easily send this off for execution. This is all done seamlessly for you so that you can analyze a trade using the options wizard, which you find here on your screen right here. That will help you analyze the trade and structure the trade that I just showed you. But once you click on that trade button, it'll pre-fill your order ticket on your First Trade account so that you can just hit preview and send this trade off for execution. This is the integration that we've done with the First Trade platform. And I hope that this is helpful in giving you a better understanding of these types of strategies and how you can utilize the tools available to you at First Trade to execute these types of strategies. So lastly, what I'll leave you with is a quick cheat sheet on these types of strategies. Today, we covered debit and credit spreads. The biggest thing to remember is that debit spreads are for when you expect there's going to be a quick and fast move, and credit spreads are for when you expect a slower or milder trend that you think will likely continue. So use debit spreads when you believe there will be a large and fast move to overcome the premium that you have to pay, such as earnings or the break of a major support or resistance level, and you think the stock's going to make a big move in a short amount of time. These are strategies with lower probability of success, but it comes off with a very strong risk reward ratio. Vice versa, credit spreads, use them when you just have a general trend without any kind of catalyst on the horizon. They can be used as earning as well when the move is kind of when you expect the move to be more muted. But it is a forgiving strategy with a higher probability of success, but it generally has a negative risk reward ratio. So what you can potentially make is less than what you can potentially lose on the trade. So those are the trade-offs that you generally make. Like I said, one strategy is not better than the other. It's about deploying the right strategy depending on your outlook of the underlying stock. With that, that covers what I wanted to share with you here today. What I'll open this up is for Q&A at the moment. If you have any questions, type your questions into the Q&A window at the bottom of your screen, and I'll try to answer as many questions before I sign off here for today. Like I said, there's a Q&A window at the bottom of your screen. If you click on it, you'll be able to type your questions, and I will try to answer a few questions before I sign off. And just a reminder, the options wizard, when you go to your first trade platform, you can find your options wizard. You can do it on your homepage, or if you go to your options, your options trading page, and even your options research page. This is all powered by Options Play. You can find these types of strategies. We even have a credit spread opportunity report. These are credit spreads that have the highest or have the best risk to reward at the current moment. And you can sort it based on bullish and bear strategies. You can look at exactly which strike you're buying and selling, what your potential risk and reward ratio is, how much you can potentially make versus how much you can potentially lose, whether there are earnings or not coming up. And if you like it, you can simply click on the trade button and we'll actually pre-fill the order ticket for you as well. So you can do this for finding credit spread opportunities. You can use it for trading debit spreads. There are a lot of tools that are available to you here at First Trade to help you better understand these types of strategies. Okay, so let's look at some of the questions that have come in. Lee is saying, how do you select the right spread width between the two legs? Great question. We generally take a delta-based approach when we're looking at finding your strike prices. So we're always buying or selling the at the money strike, and then the out of the money strike, for debit spreads, we usually go out about one standard deviation. So for example, in our bullish example, I was looking at the whoops, sorry. Let's load that again. I apologize. I was looking at the 170, 185 call spread for Apple. That 185 strike is the one standard deviation move for the expiration date that we're looking at. So for May 17th, the 185 is, if you look at the 185s, it's 0.19 deltas. So one standard deviation, we're basically looking for the strike price that's just inside of one standard deviation. As you can see, one standard deviation is somewhere between 185 and 190. As you can see that marking 1 SD and negative 1 SD, telling you that the one standard deviation below is between 155 and 160. So we use kind of standard deviations to select our strike prices, and we're always buying the at the money strike. So the current price is around 170, which is why we're buying the 170 call, and then we're selling the 185s because that's roughly one standard deviations away. For credit spreads, we sell the at the money strike price and we buy the 25 deltas. So for example, if let's say we go back to our short put vertical here, what we're doing is we're selling the 170 put, which is the at the money strike, and then the 165s we're buying because that's the strike price that's closest to the 25 deltas. Delta is the approximation for probability. So when I say that 165 has a delta of 0.32, what that means is that there's roughly about a 32% chance the stock will be below 165 by the May 17th expiration. We always use a probability-based approach when we select our strike prices because that's going to give us more consistent results as we trade these strategies day in and day out. If we choose strike prices based on support or resistance or other criterias, you're going to find more inconsistent results. By using a probability-based approach, we generally have a far more consistent results from these types of strategies. Mark is saying, how far out do you go in terms of expiration? That's really a great question. For debit spreads, we usually go out about 45 to 60 days. And for credit spreads, we usually go out about 45 days is a sweet spot for selling credit spreads. What would be the best strategy for trading without considering any outlook? I generally don't recommend trading without any outlook. I mean, you have to have some form of an outlook, to trade. Otherwise, I'm not sure what you're trading. I would say that if you don't have any outlook, selling a put credit spread is probably the strategy that requires the least amount of work to go into an outlook, meaning as long as you're not overly bearish on a specific stock or ETF, selling a put credit spread is a pretty safe starting point. One, because markets drift higher 60% of the time and move lower 40% of the time. So statistically speaking, yourself in the right directional view. And even if the stock doesn't move, you will be profitable. If the stock moves higher, you'll be profitable. Only if the stock drops significantly lower do you lose money on the trade. Um, so I would say that if you don't want to do a lot of directional or view or outlook, selling your put credit spread is probably a good starting point. And that's also what our options research tool provides you with. Um, if you look at the credit spread report, anything that's under bullish and puts are is that strategy that I'm referring to, right? So, for example, if you're looking at Coinbase, let's take a lower price stock. Let's look at Lyft, right? Lyft is trading at $18.70. We're selling the 18 and buying the 16. So as long as the stock stays above 18, you'll make in this particular case 87 cents. And you're risking in this particular case, about $1.13, right? So you're making $87 while risking $113. As long as the stock stays above 18, you'll make that, right? So that's where you can click on that trade button. It will populate everything for you. You just have to type in the number of contracts to trade, and you can send this off for execution. But that's kind of what the credit spread report is designed to do, is help you find these opportunities where the risk reward is as favorable as possible. So as you can see, the premium versus the percentage, the higher this ratio, the better the risk reward, right? So in Coinbase here, I can potentially make $18.25. The width of the strategy is $40. So in this particular case, I can make about $1,800 and I'm risking about $2,100. So the risk reward ratio is very close to 1-to-1 in this particular example. Can I use beta in selecting strike prices? No, not really. Rather you sort of can, but the delta inside of the option chain is already accounting for the volatility of the stock. So the more volatile the stock is, the further the strike prices will calculate the probabilities based off of. So you've got the right idea, but beta is not the right metric. You use delta. Delta already accounts for how volatile the stock is, and it calculates it appropriately and allows you to select a strike price. So when something's more volatile, it will naturally help you select a strike price that's further away. For stocks that are less volatile, it will naturally select strike prices that are closer to the current price, because delta is already accounting for the expected volatility of the stock. Do you do any trade management strategies when the trade is going against you for credit spread? For example, adjusting or rolling a leg. I generally don't like doing that because you're basically risking more money on a bad trade. If the direction that you expect to do is not working out, don't throw good money after bad money. Just get out of the trade and place a new trade on something else. Um, you can get back into a trade if you feel pretty confident that it is going to come back, but I still think that you're better off taking a loss on the initial trade, because clearly the timing on the initial trade hasn't worked out. And then if you want to enter a brand new trade because you think the timing is better now, feel free to do so, but kind of don't confuse one bad trade with the next bad trade. Kind of remove yourself from one trade and then kind of clear your thoughts and get back into a new trade. I don't particularly love rolling losing trades, because then you're just potentially um, throwing good money after bad money. Please review why exit at 21 days to expiration. Um, you don't have to stick to the 21-day rule. You can use 14, you can use 10, but you should have some type of rule to exit before the trade reaches expiration, because you have a short strike that's near the current price of the stock. You have expiration and assignment risk as you get closer and closer to expiration. And you just generally just don't want that as a credit spread seller. Because if you get assigned, you need to have the cash to own 100 shares or short 100 shares. And that's going to suck buying power from from your account. If you have the cash and you don't have the cash, you're going to get liquidated. So it's just not a nice experience for anyone. So that's why we have that 21 days to expiration. That's going to avoid assignment risk, and you're just going to not have to find yourself in that position. How many contracts would you consider to be conservative for a new trader? That's a really great question. I'm glad that you asked that. Let's go back to our example. We have a risk and investment calculator built into options play to help you solve that exact problem. There should be no gray area as to um, how many contracts you should trade. You should know exactly how many contracts you should trade, and we have a calculator that helps you do that. So let me just get this loaded up here, and I'll show you this here in 1 second. And I always seem to have problems loading this in Safari from time to time. Let me try this one more time. Okay, so let's go back to our example where we're going to buy this 170, 185 call vertical. We have what we call a risk and investment calculator. What I always tell investors is that you should calculate what is 2% of your total account value. Meaning, let's say you have a $100,000 portfolio. You should never risk more than 2% of that total portfolio value on any trade. So what you do is you take your portfolio value, multiply it by 2%, whatever that number is, you plug it into this risk and investment calculator. You have a $50,000 portfolio, 2% of that is $1,000. You click on calculate and we will calculate for you the appropriate number of contracts to trade. You have a $100,000 portfolio, you come here and you click on calculate, we'll tell you can buy 3 contracts of it. And what this will do is make sure that the max risk of the strategy that you trade does not exceed what you put in as your max, as your risk, what you're willing to risk. So we actually have a calculator built into it for you, and then you can click on trade, preview order, and send this order for execution on your first trade account. So this will already pre-fill for you the number of contracts if you use that risk and investment calculator. Do you do tighter spread or wider spread in the money, out of the money spreads? So Lee, I think I've already covered kind of how you want to think about selecting strike prices. Tighter, we always use a probability-based approach to selecting how wide or narrow your strike prices are on this. What is the minimum buying power that you need to get level 3 options? That's a question for first trade, so you're going to have to direct that question at first trade support. How would the ticker being in an individual stock versus an ETF affect which strategy to use? So, I mean, ETFs, you're generally going to be less likely in a position where you think the ETF is going to make a big fast move in a short amount of time. It's usually single stock that you kind of have those scenarios. It's usually, earnings coming up, product announcement, things like that will generally move the markets. With ETFs, macroeconomic events can move the markets, like payrolls coming out this Friday could be a mover of events. The Fed meeting is a potential mover of ETFs. But generally speaking, fewer things move ETFs a large amount than single stock. So a lot of times when you trade ETFs, you will gravitate towards trading more credit spreads, and single stock will give you more opportunities to trade debit spreads. So hopefully that answered your question, Justin. Yes, these sessions are recorded so that you are able to access them at a later time. One contract naked put 95 call 110 net at $6 credit. Monty, I'm not sure I understand your question. You're gonna have to be a little bit more clear as to what you're trading in that particular example. What is your trade you recommend on an index ETF like a QQQ or SPY? I think I just answered that question before with regards to single stock versus ETF. How is IV calculated? Is it current or historical volatility? It is implied volatility. IV is implied volatility. It's calculated, it's backed out from the options price. So the option price is effectively the market's future expectation of volatility. There's a fairly complicated formula for calculating it. Different firms have different models for calculating implied volatility, but it is calculated based on the current price of the option, and it is what we call implied volatility. It is not current or historical. How does the index, how to decide the index level for the index option? So it doesn't matter whether it's an index or a single stock, how you select your strike prices are exactly the same. You use a delta based on, aren't these opportunities and the trade ideas tricky? Like the premiums are so high because some traders are afraid the price will actually drop significantly from fundamental reasons. I'm not sure I truly understand the question here. I'm not sure what it is about that's tricky, and what do you mean by premiums are so high because they're afraid it's going to drop? If you don't mind clarifying, that'd be great. Is there a situation when the number of contracts for leg one and leg two must be different? No. For vertical spreads, they must be identical. You cannot trade a vertical spread where one leg has a different number of contracts than the other leg. The definition of vertical spread is that both legs have the same number of contracts. Okay, those are all the questions here for today. Thank you so much, everyone, for taking the time out of your afternoon. I hope that this was helpful in giving you a review of debit versus credit spreads. More importantly, giving you an understanding of when to use it, how to use it, and showing you some of the tools that are available to you at First Trade to help you structure these trades, find opportunities, and execute them in your First Trade account. With that, thank you so much. I hope you guys have a great trading day, and we'll see you guys here in 2 weeks' time on our next options education session.